Hi there, welcome to Kneppy Invest, and welcome to another article reaction video. Today I'll be looking at Motley Fool's article titled Top Brokers Name 3 ASX Shares to Buy Next Week. Three interesting companies in this article written by James Mickleborough, but he did get all this information from three particular brokers, Bell Potter, Macquarie, and Morgan Stanley. And these three brokers have recommended three interesting companies for various reasons. What I've decided to do is spend most of this video focusing on Elders and also have a brief look at the other two companies, IDP Education and Lynas. So let's go into looking at these three companies. Now, whenever I'm looking at a company, no matter how knowledgeable I am on that company, I always want to answer the question, is this company high quality or not? Because depending on the answer to that question, I will have different strategies, investing strategies for those companies. For instance, if I consider a company to be high quality, I'm more likely to want to hold that company for the long term. And the next question then becomes, is this company good value at current prices? If it is, this could be a long-term hold. If I consider a company not to be high quality, it all comes back to technical analysis and also a little bit of valuation as well. Now, you probably already know that I don't consider agriculture companies or mining companies to be high quality. So it should not shock you that I don't consider Elders or Lynas to be high quality companies. So what about IDP Education? Well, another thing that might not shock you is because IDP Education is highly influenced by government regulations, straight away, that means it's going to struggle to be considered a high quality company based off my criteria. So straight away, coming into this article, I knew I had a pretty good idea that I would not consider these three companies to be high quality. Now, we'll end on with Elders because I do want to get into a little bit of detail when it comes to this company, particularly the history, which I found interesting. So let's start off with IDP Education. And Macquarie is saying this company is a buy because the share price has dropped a lot. So they're saying there might be some good value here. So their price target has been reduced to $6.40. By the way, the share price of this company currently is 3 something. So $3.59. Yes, 3.59 cents. Share price of IDP Education has dropped by more than 90% since its highs back in 2021. But I'll touch upon that in a second. If we go back to this particular article or this recommendation from Macquarie, even though they have reduced their price target, they remain positive on the company following a very disappointing market update last week. The company's update revealed a significant drop in volumes because of tough trading conditions in the international student market, and a lot of that is because of changes in government regulations. Macquarie highlights that IDP Education EBIT guidance is approximately 30% lower than both its estimates and consensus forecasts. As a result, its analysis have taken axe to the estimates for financial year 25. They've also done the same for 2026, 2027. But due to a heavy decline from IDP Education shares, Macquarie believes that they are attractively priced at current levels and is urging investors to pick them up while they are down. There may be some truth to this, that the share price has dropped a lot and there may be some value right now, but I can almost guarantee you, as the share price has dropped from its highs at $40, all along the way, there have been people saying, including experts, oh, this represents really good value. So when the share price was at its high, when was that? That was $40 back in November 2021. Share price actually did drop a fair bit from $40 all the way down to just above $20 in about 6 or 7 months. And I can almost guarantee with that 50% drop, there would have been a lot of experts saying, what a great bargain this is. What a great bargain. But since then, the share price has dropped another, 60 to 70%. So just because the share price of a company has dropped a lot doesn't necessarily mean it is good value. So there is a lot of uncertainty when it comes to this company. We just don't know what's going to happen with future government regulation when it comes to international students. Maybe this is the low point, and I'll emphasize that word, maybe this is the low point. Maybe this is the bottom for IDP Education. We just don't know. So when it comes to these sort of companies, the first thing I always look at is, even though I already knew I probably not consider this company to be high quality, one of the things, first things I always do is just have a look at some of the financial metrics. So let's do that. The ticker code for this company is IEL. And the funny thing about IDP Education is if you do look at some of their financial metrics, you get a pretty good, you might be, I wouldn't say fooled, but you might have an inclination to call this company high quality. So this is all backward looking, and a lot of the things I do look at, a lot of the financial metrics I do look at are backward looking by 3, 5, even 10 years. And in that sense, you do get a feeling that maybe this company should be considered high quality. For instance, revenue growth has been, has been growing at 15.1% over the last 10 years. Even over the last 3 years, it's been growing at 12.5%. So that does give you the wrong sense about this company, because all the struggles we have seen in IDP Education have been the last few years. Earnings per share have been growing at 15.6% over the last 10 years, 16.5% over the last 3 years. Gross margins, okay, 30.6% gross, 17.7% operating margins. Return on equity, return on invested capital, 5-year average, really nice at 22.2% and 15.5% respectively. So just these metrics, there is a sense that, yeah, IDP Education, high quality. P ratio 10.5 right now. So maybe high quality company, but it's really good value. The other thing I should mention here is I did have a look at returns, and I do like to have a look at the backward returns of a company, because if I find that I'm considering a company to be high quality, and I also see sort of mediocre returns over the last 5 years or so, that could be a good sense or good indication that maybe the company is good value. Now, with IDP Education, the last 5 years, the company has given a negative 25.9% return to the shareholders. So maybe that's a good sign. Over the last 10 years, it's actually 2%. But what I also did is I went from when the company listed back in, I think it was 2016, through to the share price high. This company, and that was over a 6-year period, by the way. So over a 6-year period, this company gave their shareholders a 49.6% return per year. So that is spectacular return over a 6-year period. And that's one of the reasons why I do think a lot of experts back at that point in time, 2021, 2022, consider this company to be really high quality. I still remember Rudy just talking such great things about this company. Oh, IDP Education, what a great company. Absolute buy. And that's when the share price was at its high. And even though the P ratio of the company was significantly stretched, I'm pretty sure at one point the P ratio of this company was above 100. These experts didn't care. It was a growing company, nice growth in revenue. They didn't care that any sort of government changes in regulations could negatively affect this company. And that is exactly what we've seen over the last few years. Okay, so we have seen the share price drop probably over 90% in a fairly short period of time. Yeah, well over 90% in a fairly short period of time. And when I say fairly short period of time, I'm talking about 2 or 3 years. So is there value? Is this a good buy right now? A little bit too much risk for my liking, because we just don't know what's going to happen in the future. This sort of change in mentality when it comes to international students could be around for the next 5 years. Or it could change within the next 6 months. We just don't know at this point in time. So in this sort of situation, I probably would prefer just to wait for some sort of sign that things are starting to turn positive. And even if that does happen, you won't see the share price jump up 500% in one day. It will be I wouldn't say a slow grind higher. You might see an initial jump, and then you'll start to see the share price move into an uptrend. So I do think you can be patient with this one. So let's have a look at the chart for IDP Education. So we'll have a look at the weekly chart. So you can see, yeah, from when it listed, I think it was spun out of somewhere, November 2015, share price at that point was around about $3. So in fact, the share price is near an all-time low right now. So this actually looks like a Matterhorn pattern, which I saw a lot we saw a lot of Matterhorn patterns. This is just my own pattern. We saw a lot of Matterhorn patterns back in 2022, particularly in tech companies whose share price went up, the top of Matterhorn to the top, and then when interest rates started rising, we saw the share price of those companies just drop like a rock. So this is a very similar pattern. And this is actually not the chart of a high quality company. That's the other thing I should mention. Not the chart of a high quality company. But maybe Macquarie is right. Maybe now is the time to think about buying some shares in IDP Education. But it's based, I think you have to be a little bit more of a risk taker at this point in time because we just don't know what's going to happen in the future. And if we just focus on the daily chart just looks horrible. This is a great indication, a great example of a company you don't want to be invested in because the share price has been a well-defined downtrend for a while and there's no end in sight. Even though they have released some pretty bad news recently, doesn't mean the end is in sight. In fact, we have not seen a bounce yet. Really high volume coming through and no bounce at this point in time. So that's Lynas. Now on to, no, that's IDP Education. Now on to Lynas. So let's have a look at Morgan Stanley. So analysis of Morgan Stanley have retained that overweight rating and $10 price target on this rare earths producer shares. According to the note, the broker has become even more positive on the company. This is due to Lynas's potential to increase production thanks to the new Kalgoorlie facility. This is particularly important given its position as one of only 2 global rare earth supply producers outside of China. What's the other one? I knew Lynas was one. I've always thought Lynas was the only global rare earth supplier. I'm actually a little bit keen on this because I don't know the other one off the top of my head. Copy and let's just put it to JBT. See if I can answer just based off that little comment. Lynas and MP Materials in the United States. There you go. Okay, so let's go back to Lynas. And what I'll do is, Lynas is a mining company, and I would not consider mining companies to be high quality. So straight away, I knew which route I was going to go down with this company. But I still thought I'd just have a look at some of the financial metrics. Revenue, to be honest with you, revenue growth over the last 10 years, 15.4%. It's pretty nice. But the last 3 years, negative 7.1%. And we have seen earnings per share of this company dropping over the last 3, 5, and 10 years. In fact, over the last 10 years, earnings per share going backwards by 29.1% per year. Gross margins fairly low, return on equity, return on invested capital nice, P ratio 169.3. Some might say you buy mining companies when the P ratio is really high, not when it's really low, because that could be maybe an indication that it's at the bottom of the cycle. I don't really follow the movement in rare earths prices all that much. So we're talking about, I can't even pronounce some of these names: yttrium, lanthanum, cerium, prosodium, neodymium, promethium, samarium, europium, gadolinium, terbium, disoprosium. I wouldn't have any clue how to follow the prices of these sort of minerals, or whatever you want to call it. Yeah, rare earth minerals. Anyway, so one of the things I always do is have a look at the return. So if you have a look at the total returns of this company, probably could I even just have a look at the price, because I doubt this company has much of a dividend. They don't. So total returns over the last 5 years, 33.8%. So it's done really well over the last 5 years. Over the last 10 years, 35.2%. So doing really well over a 10-year period. Over the last 20 years, let's have a look at this. Only 10.1%. In fact, if you just have a look at this particular chart on FinChat, you can see Lynas Rare Earths share price going up and down like a mining company always does. And you'll be able to see that just by looking at the chart. Just by looking at the chart, you'll be able to see this. I still vaguely remember when Lynas went into production. This would have been 2015-16, because before that, the share price of this company was as high as $26 back in 2011, and then it fell off like a rock. Share price went from $26 to a low. How low did it get? Negative sentiment when there was maximum negative sentiment in this company. Share price of Lynas was down as low as about 30 cents. And then it went to production sometime 2015 through to 2017. Forget exactly when. And that's when the share price started to go up around that time. Probably, if we have a look at the financials, we could even tell when they actually did go into production. So let's have a look. Maybe it was even earlier than that. Yeah, maybe it was even earlier than that. So it looks like they went in production prior to 2015. And we can see just by looking at revenue, massive increase in revenue from 2015 through to 2022. But the last few years, probably because rare earth minerals prices have come down a bit, the price of Lynas rare earth and the revenue of Lynas rare earth has pulled back significantly. In fact, it's halved from 2022 through to 2024. And if we have a look at the share price since then, yeah, share price not quite halved, but has pulled back a fair bit. So when it comes to these sort of companies, I do focus on evaluation, but I also have a look at the chart. So with IDP Education, chart looks horrendous, but maybe there's some valuation, but that's up in the air right now. With Lynas Rare Earths, not sure about valuation, so I'm more inclined just to have a look at the chart. And something does strike me interesting when it comes to this company. It does look like the share price is trying to move into an uptrend. Now, it is quite volatile. You can see the share price moving up and down quite, I was going to say roughly, quite violently. Can see between November 2024 and January, so over a 2-month period, share price dropped from 820 to 620, fairly short period of time. And since then, the share price has risen by about 50% from 620 to 920. Share price also jumped up a fair bit on Thursday session, 5th of June, 12.5%. I don't know why. Why did share price of Lynas go up 12.5% on Thursday? You could probably answer this or ask this. Why did Lynas share price jump up 12% on 5th June 2025? It could have been just a broker update. I don't believe the company did release anything on that day. I'm just going to confirm that. I think I would have noticed if they did release anything. So let me just confirm that. No, they haven't released anything. They haven't released anything significant for about, since their quarterly activity report. So this could be just prices of some of their minerals. Let's just see what ChatGPT says. Okay, highest level, 2 years. Significant uptake was primarily driven by escalating concerns. Escalating concerns over China's rare earth export restrictions and the impact on global supply chains. I would say if that is the reason why the share price of Lynas Rare Earths surged, this could change within seconds, within minutes. We could see the share price drop because these escalating concerns could be alleviated. We just don't know. This is not something that I would trade. This would not be a reason why I would trade a company. And this would not be a reason why I would buy into Lynas, just because of this simple thing. Additionally, broker note from Ord Minnett on the same day upgraded Lynas shares to an accumulate rating with an $8.70 price target. I would even be inclined to say that would be one of the main reasons why the share price might have increased. Okay, so Lynas, I don't mind the chart, but I wouldn't be surprised to see the share price pull back, but definitely the chart looks much better than IDP Education. Now on to Elders. So I spent actually a fair bit of time more time than I wanted to on Lynas and IDP Education. Now on to Elders. So let's have a look at what Bell Potter said about Elders. According to a note out of Bell Potter, its analysis have retained their buy rating and $9.10 price. Share price of Elders is probably $6 something. $6.12. So what Bell Potter is saying, you could get a 50% return if you buy into Elders right now. Anyway, so a $9.10 price target on this agri-business. I could call this agricultural business. Company shares. Bell Potter points out that Elders shares have underperformed materially since the announcement of its proposed acquisition of Delta Agribusiness. The broker thinks that this has created a very attractive buying opportunity for investors, especially as it believes that existing initiatives and its favorable leverage to cattle prices will underpin double-digit earnings per share growth through financial year 2027. Bell Potter also makes the point that the Delta Agribusiness acquisition could accelerate this growth profile if it is approved by regulators. So share price $6.12. Funny enough, I didn't have to look at share prices. Quoted right there. Now, let's have a look at whether I would consider this company high quality or not. And we'll go through the process I always go through. But you already know, this is an agricultural business, and I would not ever classify agricultural business as a high quality because it's a tough thing to do. It's a tough business, and there's a lot of things that can go against you that are out of your control, particularly when it comes to weather, diseases, or blights, or whatever you want to call it. Sometimes, it's out of your control. Okay, so revenue growth is actually okay. In fact, over the last 5 years, revenue has been growing at 12.3%. So I actually give that a slight tick, not a big tick. But when it comes to earnings per share, negative over the last 3 and 5 years, 4.5% growth over the last 10 years. Now, I did have a look at revenue per share growth over the last 10 years. Now, in this particular, revenue has been growing at 8.4% per year, but shares have increased, shares on issue have increased. So revenue per share over the last 10 years have increased at 0.5%. So revenue per share, 0.5% over the last 10 years. Earnings per share growing at 4.5%. So straight away, that is a bit of a red flag that we haven't seen much growth in this company when it comes to revenue per share or earnings per share. In fact, it's probably less than inflation over that period of time. Well, definitely revenue has been growing less than inflation, but I don't think inflation's been higher than 4.5% over a 10-year period. So earnings has been growing a little bit greater than inflation. Really low margins, so gross margins 20.7%, operating margins 4.3%, which is probably not a surprise for this type of company. Next thing I look at is return on equity and return on invested capital. Funny enough, this is a 5-year average in FinChat, and these numbers are about what you want to see. Now, on the low side, you want to see these two numbers get much lower. So return on equity is at 13.8%, return on invested capital 9.7%. So you don't really want to see return on invested capital get much lower than 9.7%. That's sort of the lower end of what I want to see with those two metrics. So if you just focused on those two, this could be considered a high quality company, almost. What else? Oh, the other thing I should mention is returns. So I looked at the 5-year, 10-year, 20-year return for Elders. Over the last 5 years, negative 3.5%. Over the last 10 years, 11.1%. And over the last 20 years, a negative 12.4%, which is not good over a 20-year period. So definitely not the sort of company you want to hold for the long term if there's a chance you might get that sort of return over a long period of time. Now, PE ratio is at 15.4. So straight away, I probably will not consider this company high quality. So usually the next thing I look at, by the way, the dividend yield's at 5.9%, payout ratio 90.2. So maybe you could argue this is an income stock with that sort of yield. Anyway, whenever I come to the conclusion a company's not high quality, I always think, but is it good value at these levels? Is it good value? So I saw the PE ratio 15.4 and I was thinking, maybe not. But then I had a look at the income. And if we have a look at the last year, so last year they had profit of 45.1 million. In the last 12 months, 67.1 million. So it looks like there was one half year where profit was down a fair bit. And that was the first half of last year, 11.6 million. And then went it back up to 33.5 million 2 half years ago. And then 33.6 million in the previous half year. If you go prior to this little period, this company had a profit, consistent profit of around about or between 50 and we'll say $90 million. So I was just thinking if the company could get that profit back up to those levels, just say about $50 million or so, that's $100 million of profit in a year. And the market cap currently is 1.16 billion, which would mean the PE ratio would be roughly about 10, we'll say 10 or 11, which might be a nice little level for this company. So I had a look at the history, PE ratio history of Elders. And yeah, the market doesn't pay much of a premium for this company. So right now it's at 15. And funny enough, the PE ratio of this company was 30 not that long ago, but that's because of that suppressed income in the last year. But prior to 2024, This company had a highest P ratio of about 15 and a low that was back in 2021 and a low of 5 back in 2017. So this company really has sort of has always been given a bit of a discount by the market. So don't have a look at the P ratio of 15 and think, oh, this could be good value, because historically, the market always gives this company a bit of a discount, and the P ratio can get as low as 5. And during that 8-9 year period, the P ratio ranged between 5 and 15. So if you just have a look at P ratio, just be aware of that. Some of the other things I do look at are, for instance, free cash flow yield, but I do like free cash flow yield. But this is all over the place. So some years it's negative, some years it's positive. So I'm not sure if free cash flow is the best thing to look at when it comes to this company. Now, in saying that, I did have a quick look at free cash flow, and this company's free cash flow has increased the last few years. Yeah, the last few years, we've seen some really good free cash flow come through from Elders. And prior to 2020, when this company had pretty good profit, free cash flow on occasion was negative. That's why free cash flow yield is negative in those years. Okay, what else? I think that's it. But I went to have a look at the chart for Elders. So this is the daily chart. And I had a look at the weekly chart. And I'd noticed the share price of Elders was really, really high back in the mid-2000s, and then it just collapsed during the GFC. So again, this is probably why you would not consider this company to be high quality. Now, if we just zoom in on what's happening right now, this was intriguing to me because it does look like share price around 550 is a nice support level. That's when we saw the share price reach its low back in 2019 and also in 2023. Share price is just above that level right now. So just based off that, maybe there could be some value with Elders at these levels. Share price high as high as 15 back in May 2022. So that could be sort of the upside you might possibly expect, if things go right for Elders. But I was really intrigued about what happened with Elders back during the GFC, because the share price just dropped like a rock. So I actually did ask ChatGPT about this. And I'll just show you also, where is it? Where's all my chats? Open sidebar, where is it? Well, it looks like it's not here. It means I have to. So some reason my chat has gone. I must have asked it on a different ChatGPT. Why did Elder share price drop significantly during GFC? Don't have to worry about misspellings because ChatGPT is smart enough. Okay. So Elders actually was known as Futurist Corporation. I have confirmed this. And Elders, what I found really fascinating, they were diversifying like nothing else. They had a bank. Yeah, they had a bank. I think it was a joint venture. I think it was called Elders Rural Bank. They were getting into the internet. They actually got into a joint venture with Optus. Yes, with Optus back in 2006. So they were really diversifying what they were doing. They were known as futurists, and apparently they had a high debt load, poor investments, asset write-downs and losses, share dilution and capital raisings. That's why, and the other thing they mention here is the share price dropped, or they don't mention here. In the previous one, they did mention how much the share price did drop. And you notice in the chart in TradingView, share price was as high as 260. No, what I think they did is because they raised a lot of capital, increased the shares on issue, they did a share capitalization or consolidation. That's why it looks like the share price dropped from 260 down to like $10 or even lower than that because of that. So a lot of things went wrong for Elders during the GFC. And the other thing I like in Market Index is you can go back to as far as 2006 just to see some of the announcements the company releases. So what I do, I'll just actually show you exactly what I do. So you can just put in Elders, and they have a nice little announcements. I click on price sensitive. So that does decrease the announcements by quite a bit. For instance, if you don't, you have 146 pages of announcements. But if you click on price sensitive, you whittled that down to 34. Now, it goes as far back, where is it? as far back as 2006. And you can actually see here, the first announcement is Elders Rural Bank interim profit. And another one, you can see all these futurist hybrids, open briefing, futurist CEO. Some of these, I did go through some of these announcements from futurists, and things were moving along quite well back in 2006. If we go to, there was a nice, interesting announcement on the 31st of August. Here it is. Optus and Elders announced joint bid for broadband connect funds. Yes, they were getting into the internet game, Elders, with Optus via Futurist. So Elders, a wholly owned subsidiary of Futurist, has entered into a multifaceted agreement with Optus to bring increased choice and service levels, so delivery of broadband, voice, and data services. So I found that really fascinating. So everything was going smoothly. 2007 seems like everything was going nicely. In fact, there was a profit upgrade somewhere in there. I can't remember exactly where it was. There also, if I remember correctly, it was a joint venture with Bendigo Bank, something like that. Yeah, joint venture between Futurist Corporation and Bendigo Bank, Elders Rural Bank. Don't know what happened to the Elders Rural Bank. Have not heard anything about it. And if I keep on going in announcements, more than likely they sold it off or something, because they sold a lot of assets. I can tell you that much. Anyway, so if you keep going on into 2008, this is when we started to see some negative stuff happening. So revised guidance. In fact, the first one was May market guidance statement in the 6th of May. And in fact, if you go to have a look at the chart, that's when the share price started to really drop. So May, yep, that's when the share price started to drop. In fact, on that week, the share price dropped 18.55%, and that was the start of the downtrend for this company. So this would have been, I would assume, a negative update. There was another negative update released a month later, and then the CEO resigned on the 26th of June 2008. That's as far as I went. And the other thing I should mention is you can see a lot of them selling stuff. Or maybe I did go a little bit further. Talking about a business transformation program, or maybe I did go a bit further, because I remember them just selling stakes in a lot of their stuff they do have, their assets. As price query, I did open up this price query. Share price at this point was down to 70 cents. Anyway, refinancing. I'm just looking at market update, probably would have been negative. Another price query. And earnings guidance to impact Elders' earnings expectations. And I'm pretty sure they changed their name to Elders in 2009 sometime. So it must have been earlier than this. Looks like they already changed the name. There we go. Approve recapitalization proposal. I'm just going to open this up because I would say it was probably like a 50-to-1 recapitalization or something like that. Or a consolidation. Maybe this has nothing to do with this is a recapitalization, not a consolidation. So I'm looking for a consolidation, but I can't find it yet. And so we're now to 2010. It looks like things are probably starting to get a little bit better for Elders, and they've changed the name. Still talking about the bank. Oh, sale of rural bank shareholding. There you go. Queensland flooding 2011. Impact of weather events. I'm just going to see what they did to the bank. There it is. Elders to sell 40% shareholding for gross proceeds of 106 million. Agreement with Bendigo and Adelaide Bank. There you go. So anyway, that's why the share price of Elders dropped a fair bit. Looks like things were just going good for the company. Had too much debt. Had to raise a lot of capital. Didn't see any major capital raisings announcements here. Could have gone straight past it. There were write-downs, revision to carrying value, announces completion of debt refinancing. Anyway, sales of Elders insurance operations. They were into insurance as well. Okay. Anyway, so out of these three companies, Elders, IDP Education, Lynas, I would not consider any of these companies to be high quality. But just because they're not high quality doesn't mean they're not trading opportunities. Now, Lynas chart looks probably the best just because share price has popped up and looks like it's in an uptrend. IDP Education share price just keeps on dropping. We just don't know when the end is in sight. And again, it's up to changes in government regulations. Things could improve. They could get worse. We just don't know. Elders chart, it is near support. And I do think there is a possibility that there could be good value, at least fair value, particularly if we do see a nice increase in profit to say $110 million. That would mean the PE ratio is about 10. And if they can actually increase their profit a little bit more, you can actually say maybe there is some good value for Elders. But again, be aware this company is in a tough business. Agriculture is tough. And sometimes management can do a really good job, but the business can do a really bad job because there are things out of the control of management. So that's all I have for today's article reaction video, looking at Motley Fool's top brokers name 3 ASX shares to buy next week, which is this week from when I'm speaking. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.